As of 10:50 a.m. Eastern Time on Monday, February 2, 2026, BigBear.ai Holdings Inc., trading under the ticker BBAI on the New York Stock Exchange, is currently priced at $4.93 per share. This represents a decline of 2.18% since the opening bell, where it started the day at $5.04. The intraday movement has seen the stock dip as low as $4.84, showing some immediate selling pressure as the market digests the broader tech sentiment. While many retail investors see a sub-$5 price tag and think they're getting a bargain on the next massive intelligence play, the reality on the tape today tells a story of institutional hesitation. High-frequency data shows a volume of over 12 million shares already changing hands, but the price action remains heavy, struggling to reclaim the $5 psychological level. What most people are missing right now is not the price itself, but the massive divergence between the company's recent partnership wins and its actual balance sheet stability. While the headlines are buzzing about a strategic partnership with AD Ports Group to develop AI customs management systems, the market is quietly punishing the stock for its persistent negative earnings per share, which currently sits at approximately negative $1.54 on a trailing 12-month basis. Investors often expect that AI in a name guarantees a parabolic run, like we've seen with NVIDIA stock. But the reality for BigBear.ai is that it is fighting a battle of execution versus narrative. You see, the general belief is that because they serve the Department of Defense and high-security sectors, their revenue is sticky and guaranteed. However, the contrarian view, the one the smart money is betting on right now, is that their heavy reliance on government cycles is actually a liability in a high-interest rate environment where federal budget delays can paralyze a small-cap firm's cash flow. If you look at the recent daily swings, we are seeing a classic battle at the $4.90 support zone. Just a few days ago, the stock took a nearly 9% hit on massive volume, and today's continued weakness suggests that the dip buyers are being overwhelmed by larger players who might be reallocating capital into more stable SaaS or hardware names. When you compare BBAI to something like Apple stock, the volatility profile is on another planet. While Apple provides the stability of a fortress, BigBear.ai offers the raw, unrefined volatility of a company that is essentially a high-stakes bet on the future of autonomous intelligence. Institutional activity has been lukewarm, with institutional ownership hovering around only 7.5%. That is a red flag for many who use a professional online investment platform because it suggests the big boys aren't ready to back the truck up just yet. They are waiting for the reality of the margins to catch up with the expectation of the technology. Let's talk about what is actually happening in the trenches of the market. Online investing has become incredibly accessible through apps like the Robinhood app or SoFi Invest, which has led to a lot of retail noise in BBAI. On many investing sites, you'll see people comparing this to Palantir, but the data shows BigBear.ai is actually losing some ground in terms of market share while Palantir accelerates. The tension here is palpable. If you are using a self-investing strategy, you have to ask yourself if you are buying a company or just a ticker symbol that moves with the AI tide. The recent acquisition of CargoSeer assets and the $250 million deal for Ask Sage show a company that is trying to buy its way into growth. But when you look at the Fidelity Investments or the Schwab Intelligent portfolios that hold these types of small-cap tech stocks, they are often doing so as a tiny fraction of a much larger diversified basket because the risk of dilution is very real here. In fact, management's recent moves to increase share capital have sparked fears of a massive dilution event. This is where the smart friend over coffee advice comes in. In the world of online investment, growth is great, but funded growth is better. If BigBear.ai has to keep issuing shares to keep the lights on while waiting for those government contracts to pay out, your slice of the pie gets smaller every single day. The company is currently navigating a technical landscape where it's trading below its 50-day and 100-day moving averages. That's a signal that the medium-term trend is still bearish, despite the occasional 10% or 20% relief rally that catches the eye of people looking for investment help on social media. Now let's peel back the curtain on the business model. BigBear.ai isn't just making software. They are deeply integrated into the defense and security sectors. Their true-face facial recognition technology is used in U.S. airports with over 99% accuracy. This is high-level, mission-critical stuff. Their recent expansion to Abu Dhabi and partnerships with international holding company subsidiaries show they are trying to diversify away from just U.S. federal spending. This is the reality that might eventually exceed expectations. If they can prove that their AI customs and logistics solutions are scalable globally, they stop being a government contractor and start being a global tech power. But for now, they are still a company with $158 million in revenue that is struggling to turn a profit. For those of you managing your own individual brokerage account or using a Fidelity mobile app to track your trades, the sector momentum is the wind at your back, but the company's specific weights are the anchor. The AI software platform market is expected to grow to nearly $89 billion by 2034. That is a massive tailwind. But if BigBear.ai continues to see revenue declines, like the 18% drop reported in recent quarters, it won't matter how big the market is. It's like being in a fast-flowing river but having a hole in your boat. You're moving, but you're also sinking. Interactive brokers' fees and complex trading platforms might be where the professionals are shorting this stock, while retail traders on the Robinhood trading platform are trying to catch the falling knife. This is the classic expectation versus reality trap. The expectation is that AI is the future. The reality is that not every AI company will survive to see that future. We've seen this before in every major tech cycle. You have the leaders, the laggards, and the companies that get acquired for pennies on the dollar just for their intellectual property. I want to hear from you on this because the community sentiment is often a leading indicator for these high volatility names. Comment below how many shares of BBAI you currently hold, or if you've decided to move your capital into something like Nvidia stock or even diversified Fidelity ETFs instead. Are you betting on the defense AI niche, or do you think the commercial competition is too fierce? Looking ahead, the catalysts are clear. We have the Q4 earnings report coming up in March. That is the moment of truth. If management can show that the $380 million contract backlog is actually converting into recognized revenue and that their cash burn is stabilizing, the stock could easily reclaim that $7 resistance level. However, if we see another guidance cut or more talk of share issuance, the $4 floor might not hold. Macroeconomic pressures like shifting federal budgets and the potential for further government shutdowns remain the X factor that could derail even the best technical setup. The future outlook for BBAI is a binary one. In one scenario, they successfully integrate their recent acquisitions, leverage their new Middle Eastern partnerships, and become the leaner, meaner version of Palantir for specialized customs and defense work. In the other scenario, they remain a zombie tech company, constantly diluting shareholders to fund operations that never quite reach the scale needed for profitability. This is why intelligent portfolio management is so important. You can't just invest online and hope for the best. You need to understand the mechanics of the business you are buying. When you use a SoFi robo-advisor or interactive brokers trading tools, you're getting the data, but the insight comes from seeing the tension between what the company says it will do and what the SEC filings actually show. Right now, the filings show a company with a healthy $390 million in cash, but a net loss that would make most investors wince. The bridge between those 2 points is where the profit or the loss will be made for you as an investor. To summarize the situation as it stands today, February 2, 2026, BigBear.ai is currently a high-risk play that the market is treating with extreme skepticism. The live price of $4.93 reflects a market that is waiting for proof of life. The expectations for the AI sector are at an all-time high, but the reality of BigBear.ai's financial performance is creating a massive credibility gap. If they can close that gap by the next earnings call, the upside is substantial because the market cap is still relatively small at $2.2 billion. But if the reality of their revenue decline continues, the AI label won't be enough to save the stock from further technical breakdown. The central insight here is that BBAI is no longer a story stock. It has moved into the show-me phase of its life cycle. The novelty of being an AI company has worn off, and now they have to compete